Hello and welcome to your Monday Futures Market Outlook for September 24th, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out the MiniSource.com trading room, complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we can see here the U.S. dollar has had a pretty dramatic drop over the month of August as now all of the liquidity that's coming in through quantitative easing measures by the Federal Reserve has certainly created some short-term downwards pressure on the U.S. dollar. Over the last week, we've seen a bounce off of the bottoms. We've been, since last week, looking for a pretty good risk-reward proposition of going along the U.S. dollars as much of the oversold state is leaving lots of room for bounces. We still believe that there's room here for the index to head up toward 81 or even as high as 82 under the right environment. That doesn't make the bigger picture trend up at this point, but it certainly is going to leave there room for a little bit further upside potential in the U.S. dollar. Next, I want to take a look at the Euro FX futures, and the Euro had a very substantial strengthening cycle as the U.S. dollar weakened, and we hit a key overhead resistance level and have now been flagging back downwards. It's likely that the Euro at this point can go even as low as the 127.50 level to find supports. If it does find support there is room for a bounce back up toward the highs, even a potential for a higher high at some point. But at this stage, the Euro continues to be weakening, and we'll be watching where the supports come in. There's two levels we're watching. 129 is around this zone where we're currently trading, and then again at around the 128 level for some of the Fibonacci zones, as well as the highs of June. And so watch where the consolidation goes down to. Next year, I want to take a look at the 30-year Treasury bond, and even last week we were talking about the idea that the risk-reward proposition of going long bonds after that sell-off had some merit. At this stage, those supports are holding and bonds are strengthening off of those lows. This is going to be a crucial moment right here this week. We're right now approaching the Fibonacci retracement zones of the last sell-off, and if this entire correction in the bond market was simply that, a consolidation from which bonds will yet strengthen again, then we will see meaningful price progress of the bonds through these current levels. If we see substantial difficulty of the bonds to strengthen much higher than this 148 level up ahead, then that would be a little bit concerning, and at that point we will revisit the idea that bonds could weaken again. So let's watch what kind of follow through we get throughout this week. Strengthening through 148 and 149 would be very substantially positive for bonds. Next year, I want to take a look at copper futures, and copper had a very material rally higher based upon the quantitative easing announcements, but really has been consolidating for the last week. We're anticipating there to be further consolidation, but we were suggesting that so long as the bulls can keep the price action above the 355 focal point, that would remain relatively bullish for copper, when leaving room for further strength at some later point. It would take material deterioration below 355 for us to again become bearish copper. Next year, I want to take a look at crude oil, and crude has had a very material breakdown. And we've been discussing that rising wedge formation off of the June lows all the way up toward the 61.8% retracement that it just was tested right here at the 9,900 level on the upside. This reversal is pretty significant. While we're certainly not too eager to want to rush to short it at this point, but we will be watching what happens as we approach that 88 to 90 zone where the support is coming in. If we find support down in that lower level, then that will be a place from which we could see a material bounce in crude oil back to 94 to 96 dollars on the upside. Really, that will be a very important event. What will happen here, because when we do finally get the bounce in crude, if we fail to make it back up to the previous highs, then that may open the window for much bigger corrections in crude oil going into the latter part of the year. What we want to see, if you want to be bullish crude oil, what you want to see here is that these support lines kick in the next few dollars lower, create a solid short-term bottom, and we see price action that reverses the market right back up towards that 98 to 100 level over the remainder of the month. If we see that kind of price action, then that actually would leave plenty of bullish opportunities, but that has a lot of work to prove a storyline like that out. So let's watch to see first of all whether the support comes in and where the market goes from that support. Next here, we're going to take a look at gold futures, and gold continues to find overhead resistance along the highs of the year. While gold has made a very bullish run, and we remain in the bigger picture now bullish gold. There is definitely a point here where gold should naturally correct. That correction probably will emerge as a buying opportunity, but we could see as much as even $100 on the downside off the highs for bullion, as we could see a proper retracement to some support lines that lie in the 1700 or even 1680 levels. In the big picture, even if there was a very dramatic sell-off that went all the way back to that 1640 level down below, so long as that support came in at and reverse the markets from there, that would be still relatively bullish. One way or another, we are at this point feeling that there is plenty of room for gold to have some sort of a corrective pattern, and we think that profit taking some of your gold positions for those shorter term swing traders makes a lot of sense. If you're bullish on the long term buy and hold style, then you can ride out any short term dips. Next year, I want to take a look at the S&P 500, and we can see the S&P 500 had a very bullish push on the initial reactions to Bernanke's announcement, but have really spent the better part of the last 6 days just absorbing that run. This still could develop as a bull flag that has the potential for the market to break higher, but profit-taking cycles here would be very natural. If we see a pullback, we'll be looking for support in the 1425 to 1435 level, where we could see the next short-term little buying opportunity. But we do believe there's room for corrections here, so we're very cautious, as even if there is a short-term pullback and then a rally, we think there's only limited upside potential at this point from where the markets are. And even if we do get, let's say, a dip to 1435 and then a rally up to 1480, that probably will still mark the highs of where this cycle should end. And once we have a much more meaningful market correction, that could create the base from which and the market has the strength to make another substantial advancement in a bullish push. But really at this stage, we think that much of the momentum has been spent, and the periods of consolidation are much more probable as we go forward. Just to review our key intermarket observations, we at this point think that the risk-reward proposition of owning U.S. dollars is actually good. And even though we now are no longer long-term bullish the U.S. dollar, we do believe that it is going to be range-bound against a lot of other currencies like the euro and the yen. And because of that, we believe that the U.S. dollar is at the bottom end of that range, and there's room for bouncing back towards the top. And so therefore, the risk-reward proposition of accumulating U.S. dollars is pretty good at this point. Commodities at this point have a very average risk-reward proposition, while things like oil are pulling back. Gold and copper have yet to really make any meaningful corrections on the downside. Really at this stage of commodities, at some point do have a proper pullback. It'll probably correspond with a pop in the U.S. dollar. So what we'll probably end up doing is end up going neutral U.S. dollars and then changing the short-term risk-reward proposition to good for commodities. Same with bonds. Bonds have been bouncing off of those lows. We were suggesting that that was a good risk-reward proposition place to be accumulating bonds. We are seeing that follow through. We want to see this 148, 149 level on the 30-year Treasury bond continue to be exceeded in further rallies, which if we don't, then we may very quickly change our stance on the short term. But right now we're going to stick with the good stance that bonds can progress from here. As for stocks and U.S. stocks and global stocks, while the trend has been up, there's a continued diminishing benefit to remaining long this market, as there's a huge amount of optimism and substantial progress higher that the market has already made. And really, as the market progresses any higher, the amount of risk you're taking for the potential reward of staying long is a diminishing proposition, and the only place we'll be looking to accumulate equities is into any corrections, or otherwise above average holdings of cash is still a reasonable proposition here. That was your Monday Futures Market Outlook. Thank you for joining me.